seen me before. I'm Suzanne Murphy. I'm a principal at Lampy Conway and Company. I also have my family office, and I'm also one of the hosts of Resilient Alpha, which is our podcast. I've spent the majority of my career on the credit side. I traded converts back in the day. I was a partner of a hedge fund called Claren Road, which we sold to Carlyle in 2010. I can't believe it's been that long. And Lampy Conway was a fund that focused on lower middle market special situations, event-driven, but distressed credit and equities, small cap, and then became a family office. And now we think the time is right to reboot that strategy. And the team has stayed together the whole time. So we are looking to do the same thing we did before with the same team of people who did it, and we think now is the right time, because we think small cap companies are going to have a much harder time accessing capital, particularly as the markets become more volatile.
Good morning. Thank you for having us in this event. I think background, most of my large company experience was at BlackRock, but it was at a previous company. It's been all about credit across the board. It's structured to begin with, and then private at Newell Capital. I formed Newell Capital in 2008, single GP, effectively my family office. But within that, we have many different ventures. So we're very much both private equity and private debt. We are users of a private debt, meaning that we borrow, and we borrow on large projects that are highly scalable. And I think my experience in credit, 1998, the first one, Asian crisis. Second, 2001. Third was obviously, I'm sorry, 1998, 1991. That was the bubble, and then you went into the 2001 cycle, and then 2008. All of these have been at very large institutions, and we always ended up being thoughtful before going in. Primarily investor, not a trader. Has always been focused on originating and aggregating portfolios against liabilities. Obviously, private debt as an asset class has come to its currently where it is, and Newell Capital was actually pretty much was built on the credit to take advantage of these cycles. So we are definitely looking into again, take advantage of these for both our clients as well as for our own portfolio. So I'll leave it at that. A big fan of project finance and a big fan of collateral.
Thank you, guys. I'm Chip Perkins. I have a firm, Perkins Fund Marketing, which kind of explains what we do. We take funds and we market them. My son and I have been in business together now for 3 years. I've been in business for 30 years. But he's been around for all those 30 years with me because he's 30. Anyway, we are a broker-dealer headquartered in Florida. We are a third-party marketer, or we are a placement agent, whatever handle you want to put on it. We are a broker-dealer, and we've raised in excess of $8 billion for the funds that we've worked with. Yesterday, those of you were here, it's one of our funds, primary commodity fund, which presented with Suzanne. And we're excited to be here again, Marty. Thank you for having me and having us. So we have some discussion questions, but I want them to be discussions, so you guys chime in. We're going to start with the big picture. How would you characterize the current state of private credit markets? Is what we're seeing a fundamental structural stress, or is it more of a temporary dislocation that sophisticated investors should expect in a higher for longer rate environment?
You want to start, or you want me to start?
Yeah, go ahead.
So I think it's been really interesting to watch the growth of private credit, really since the great financial crisis, right? Banks had more regulation. They weren't able to lend as freely as they had been before. And so that really fueled the growth of this market. I think what we're seeing now is there's a lot of there's been some terrific underwriting, and early on, I think it was stronger. As the market grew and more capital came in faster than people could really handle it, there has been some not so great underwriting as people were trying to get capital out faster because they had to. So there's a real bifurcation in the market. And so when you're looking at private credit, you really have to underwrite the underwriting. I think that's really the most important thing. I think that there's also a structural issue in the market in terms of liquidity. You really have to understand the structure of the vehicle you're investing in versus liquidity of the underlying assets. There are vehicles that are too liquid for the underlying assets that they hold, and that we think is going to continue to put structural stress on the system, because what happens when people want to take money out, oftentimes the funds that are more liquid have to sell the better pieces of paper because that's what they can move. I think there's going to be a lot of activity in the secondary market in private credit where there needs to be workouts, because a lot of the people who have underwritten this private credit do not know how to work out this paper when there are structural problems. I also think there's a misunderstanding in the marketplace of what those assets really are. So, for example, we just redeemed from a BDC, sold it. It's a publicly traded vehicle because there's all this issue of software companies having been issued private debt, and the software space and real concerns, particularly with floating rates as well as rates have gone up, creating problems. But a lot of these funds or BDCs bucket things. They might say, well, we have 20% software and 20% in healthcare and 20% in technology and 20%, whatever it is. And if you really get under the covers, you find out that some percentage of that 20% of healthcare is really software. So, they might say they have 20% of the portfolio in software and it's money good or this and that, but then you really dive under the covers and you realize there's 60% exposure to software. It's just bucketed differently. So you really have to look under the covers and know what is in these portfolios. But I think one of the biggest issues is liquidity mismatch. And I think that's going to create some real structural stress in the system. And I think, there's private credit opportunity and direct private credit is really a synonym for direct lending. But there's a lot more going on in opportunistic credit. And I think that's going to be a much more interesting place to look, particularly for high net worth and family offices who have tax considerations, right? Because one of the issues with private credit or direct lending is it's all ordinary income, basically, at the end of the day. And then the last thing I'll say is leverage, right? I mean, I often get asked to speak on credit panels, and it'll be myself and 3 real estate guys. And they'll say, well, what are your expectations for returns? And I say, we look for low to mid-teens net over a cycle. And they're like, oh, well, we look for low to mid-teens net over a cycle. It's the same thing. And I'm like, yeah, but we don't lever. You're levered 4 to 1. And so I think that's a really important consideration when you're looking at these assets, to understand not only what the fund level leverage is, but what the underlying leverage of the loans that have been underwritten is.
Thank you. Jody, what do you got to say?
Right. I think, I definitely second everything that's been said. Just to add, I think private credit is not a homogeneous asset class. Every deal has got its own deal triggers, depending on who is behind the wheel and what are the motivations in terms of that making that lending. So after 2008, you had a lot of what are considered bankers out of jobs that ended up going into private credit lending at the private equity firms. If you look at majority of the firms that are doing private credit today, they came from actually equity backgrounds and trading backgrounds. So that's why it's very important to look at your vehicle and look at the manager. Don't be a tourist in the sector. This is not placed for a bunch of guys taking an opportunity and leaving. When 2001, I wanted to get into a leverage business. I went to JP Morgan. I said, we are ready to get in. It said, it's an open kimono. If you're not working on our side, you cannot just the buy side and not align with the sell side, because this is a sector that takes care of itself. It's a club. If you're not part of that club, the senior secured loans, then you don't belong there. You should be looking at CLOs or you're looking at other vehicles. As liquidity is concerned, this is not, if you're looking for liquidity, this is not for you. You're looking for income. You should have a goal, and you should look at, you look at the fund, and you have to look at in our view, again, to answer the question very directly, this is a cycle that is going to essentially get rid of the guys who came in and they're going to leave, and it's going to be left. It's not really going to be existential for this sector. This sector absolutely need it, both at the bank level, and the banks need the private debt funds. Why? Because they originate and they don't have the capital to stand. So their capital, essentially they're renting capital from the private debt groups. So depends on how the origination comes in. So I don't believe that this is like 2008, 2009, and then later on when we get into COVID, I think it's an opportunity to pick the right manager. If you're not in the sector, you should not do a direct lending yourself. And I think you either pick a very small manager or you pick a very large one. I think there's a structural issue in the vehicles that are provided. These should not be providing permanent capital vehicles that offer liquidity and I'm sorry, permanent capital like BDC that was pointed out is the right way for these guys to really look at it. You look at
or lockup vehicles, draw down long lockup vehicles.
No, and you look at if you go back to the CIT case, it was not a bank. It became a bank during the credit crisis. It survived and actually thrived afterwards. So these are opportunities for you to get into those type of things that actually you would have, I would say even over 20, 30% return over long term, because the sector will stabilize.
And just to add to the point of COVID, right? COVID allowed a lot of people to kick the can down the road because there was so much government liquidity pumped into the system. We had the falling knife trade of COVID, where a bunch of the big guys in the distress space raised a lot of money. I mean, I know one family office that made a large allocation to a manager that they had an existing relationship with to deploy in distressed when it looked like there was finally going to be a distress cycle. It was over in 6 weeks, and that the mandate of that separately managed account got changed to be more of a cash management vehicle. The other thing I would add, just based on what I said about leverage, is also understand the kind of leverage, right? Because if you've got a 3-year lend, a 3-year term on on whatever leverage you're using, that's very different than the bank being able to pull your leverage, right? And so you want to understand what kind of leverage it is. Is it fixed rate? Is it floating rate? Is there a term to it? Obviously a term is better and fixed rate is better, but you really need to understand that in the underlying vehicles. And you also really need to understand marks, because that's the other thing in this sector that's very opaque, right? It looks very smooth. It looks very, and private equity has the same problem, right? I mean, I think I said this on a panel yesterday. If you are the CIO of a college endowment and you're valued on June 30th at $1 billion and you have to pay out 5% a year, but that your direct lending or your private equity might look like the value is $1 billion, but you're the CIO and you're under the covers and they've marked it here, but the value is really, you're at 900 million. You're still paying out 5% on $1 billion. And that's creating a denominator effect, which is problematic in a different sense.
Thank you, guys. So unless you've been living at the bottom of the ocean, you've been reading some bad press of late about private credit. So do you think this is a private credit crisis or a private credit correction? And does that distinction matter to investors?
I don't think it's going to be a crisis like the financial crisis of 2008. In fact, our family office uses an outsourced CIO called ICG Advisors based in LA. And I will say that, when I was a partner at Claren Road, ICG was a client of mine, and the people there were the smartest people I had ever sat across the table from, which is why when I had my liquidity event, I hired them. They just wrote a paper on this whole subject called The Great Disappointment. So I think we really believe, and I'm happy to send it to anyone who would like, but it's a very prescient piece, which I found very thought provoking and gives some great insight into the kinds of things you should be thinking about when you're looking at this sector. So my belief is this isn't going to be a full blown crisis. There's going to be winners and losers. As you said, this is going to shake out the weaker players. I don't think it's a full blown washout. I think, as you said, we need this in the financial world, and it's a great sector. But I think that the weaker players are going to get flushed out. I think there's going to be some pain, and there's going to be winners and losers. It's not going to be a whole scale washout.
Again, I second everything that's said. I mean, the sector was created to really create a relief to the banking system at the end of the day, because for JP Morgan to underwrite these or Citi or others and put on the balance sheet, the capital requirements in Basel III, if you're looking at the regulatory side, doesn't work. That's why they created the CLO business back in the late 90s. And the private equity was essentially a way for the street and the buy side get together and provide adequate capital to really thriving companies. The question is, does it all of a sudden change its character from being senior debt to equity-like? And so right now we're looking at a bit of, essentially Wall Street being somewhat, or some of these funds being enamored with the West Side, with the Silicon Valley, and some of these are actually venture debt, but they're not being classified, so they're not backed by actually solid and stable returns. And the others, the underlying current that is going on is that a lot of companies are going through digital transformation that changes their business. Which one of these guys are going to be able to maintain revenue going forward? So that is changing also some of the underlying sectors.
Is there a robust secondaries market for this? I mean, family offices need liquidity. They may be.
Are you talking about secondaries on the loans themselves, or secondary
on the funds?
On the funds. Talk to me. We'll show it, but we have a broker dealer as well. We actually do play in the secondaries, specifically when there's a distressed seller. And that's not our primary business, but we tend to look at sectors where there is a correction. Ultimately, you have to look at the underlying businesses and the underlying funds.
I'm just wondering about the mechanisms for getting out.
No, there is.
I think the challenge I think you've seen a lot of secondary activities in private equity so far. You haven't seen it as much in the private debt market. I think that will change. I think part of the complexity around that is understanding these loans is much more difficult than understanding the investment in a private, in an LBO. These things are very hard to value, which is why I brought up marks. I would say another big concern is, we all know that there's this big push for retail to go into alternatives, and private debt, private credit has been such a buzzword that's probably something that people are focused on. And I think the retail market, for lack of a better way to describe it, doesn't understand the lack of liquidity in these products. And I think it's going to be a rude awakening, that 401ks are used to buying mutual funds that, you buy it today, you can sell it tomorrow, daily liquidity, and there's a NAV and it's liquid. I mean, this stuff doesn't really have that. And I think that's going to be problematic. So I do think you're going to see a more robust secondary market, but I'm not sure you're going to see it at the fund level. I think you're going to see it with the players selling assets and people buying them at a discount who have the expertise to work them out.
What of these loans are asset backed? Are they all asset backed?
No, they're senior secured loans, just the bank loans. Again, they're different characters.
Well, they're not all senior secured. Some are junior. I mean,
no, some of essentially covenant lights. That's why I'm saying, unless you look at each document.
And by the way, as the sector has expanded, there's been a lot more covenant light because people were trying to get money out faster. They had to get money out faster. So the underwriting has not been as rigorous, and as spreads have tightened, people have gone down in the capital stack to get the yield.
A lot of them
by saying they had to get money out, you meant the funds, people had raised the capital.
Yeah, they had to put it out. They had to deploy it. Exactly.
So they were written in a very low interest environment, and these are floaters. And the borrowers, didn't really count on the rates going up. The same thing that happened to Silicon Valley Bank. You're looking at a bank that had 150 billion, and they put a big portion of it on treasuries. So you can lose money mark to market pretty quickly. And so there's interest rate, there's credit, there's covenants, and there is definitely ability for the manager to effectively extend and forget. So those workout terms, or you can ask for more if they're in default. The question is this a default crisis right now? You're not seeing the defaults right now. There's an anticipation of defaults, right? And that's the same thing.
Default rates are still quite low. I mean,
Low,
much lower than you would expect them to be based on what's going on in the world.
They're actually much lower than the bond market, right? These are definitely viewed as being, very well, or one-on-one direct lending. So therefore, you have a lot of leeway to come in and talk to manager. So I need more collateral. I need to put more covenants.
A lot of amendments done
in a friendly way. In a friendly way, because ultimately the issuer and the lender are in the same position. They want to make sure they want to get through this cycle of a high interest, high volatility. And the question is also, this is sponsored by Blackstone, BlackRock, all the big ones. They find a way to bring in a new pension fund who had not been exposed. They give up their own upside. They give up their fees, and they get through it. Look at the B-REIT permanent vehicle that was offering a liquidity, which was 150 billion of this stuff. They got through it, right? They brought a new pension fund that put money in. So as far as the big funds are concerned, I think they're going to get through it because the sponsors are not going to let their vehicles to go down.
And I think that that's true to a certain extent because they have the scale to be able to do that. I think the smaller players are going to hurt. And I think that a lot of private equity sponsors or small companies have levered up a lot of these companies that didn't necessarily need the leverage because they wanted to dividend it out to their own investors. And additionally, people were lulled to sleep by a decade of effectively free money. So there's a lot of stuff that's been, a lot of what's been issued in the last 10 years in the private credit market, as well as the credit markets in general, is 144A and bank debt. And a lot of it's floating rate. And we all know you can buy a lot more house with a 2% mortgage than you can with a 7% mortgage. And so these things can start to get squeezed very, very quickly.
You don't see any of the funds being impaired, big funds.
Or there's some values have gone 50% down.
Is there reputational risk?
Yeah, I mean,
look at the reputational risk of Blue Owl.
Blue Owl is hurting.
The ability to raise a new fund might be problematic, right?
Yeah, I mean, look, a lot of, if they view this as depends on how they react, right? Sometimes you go back to the borrower, you get additional collateral, you get warrants, because a lot of it is, these are not a one-time lending. They come back and they give you, if the borrower has got problems, these are supposed to be essentially your relationship with the borrower is to maximize opportunities. So effectively, you have free optionality to be at the table to be ahead of. Imagine, for example, Carlyle in 2015, I think 16, had zero exposure to private debt. Now, the private debt is the bigger portion of their portfolio than it is private equity. They've been making a lot of money and growing. So this is the big sector for private equities that have shifted from equity to debt.
But again, it's levered, and going back to the issue of marks, like I think a lot of people don't realize that in private lending, it's a lot of credit beta, right? It is beta at the end of the day because it's long only. It's just really all you're doing is clipping a coupon, and people are lulled to sleep by the fact that maybe the bonds aren't par at 12%. Maybe the right value is 70 cents on the dollar. And I think when some of this stuff needs to get sold and worked out because people will want redemptions or want their money back, it's not going to be at par. And a lot of these loans are marked at par with a 12% coupon, levered and what have you, but they're really worth 70 or 50 or whatever.
So I think Ron brought up sector, like you talked about, venture debt, Silicon Valley, things like that.
The problem is actually if it's a venture
like,
that
what's
is
the problem?
identified and it's got a venture capital firm behind it, right? So that means the venture capital is the sponsor, would make sure that they raise more equity.
Typically, it's top tier venture capital.
Yeah, the top tier guys, and their job is to get their entity ultimately to effectively to list and go public. So they're going to.
We know that's been problematic for a while.
I know,
the
but
backlog to get all these companies public is like 30 years.
no, I think it's important to understand the structure of the you're in. You cannot be a tourist in any sector. If you're a tourist, you get robbed. That's been my experience.
And I also think you have to think about the fact, and we had this experience years ago. I'll give a little anecdote. I mean, oftentimes the private equity sponsors, they'll borrow the money, or the venture sponsors, they'll borrow the money, but they don't pay attention to the cap stack, right? Because at the end of the day, all they care about is the equity. And years ago, we invested in a company, which I'm sure you've all heard of, Harry and David's. And Harry and David's at the time was owned by Wasserstein and Company. Wasserstein and Company had levered it up hard, brought in a new CEO, had grand designs to build the business. The new CEO came from, I can't remember if it was Coke or Pepsi, didn't understand the nature of a perishable business, right? Because you can drink a bottle of Coke that's been in a bomb shelter for 40 years. It might not taste very good, but you can drink it. The pears go bad. The pears go bad, right? And so they missed Christmas, which is their whole business, right? Basically. And the bonds went from 70 to 50 to 30. We were buying them all the way down. We finally called up Wasserstein and Company, said, do you realize they're like, what? The bonds are at 30? And we're like, yeah, and we're about to donut you. What do you want to do? In that case, they came in behind us, bought debt, and we worked collaboratively with the private equity sponsor throughout this new CEO, restructured the business, and 18 months later sold it to 1-800-Flowers. But this is not an uncommon story in terms of how private equity or venture sponsors forget about the cap stack. They've borrowed the money because money was cheap. They were able to give it back to their investors, and now it's the company's problem. And it becomes a problem.
Yeah, I think this is exactly what's going on. As far as family offices are concerned, if they want to get into the sector, this may end up being a good opportunity at the right price and at the right situation where you're providing, but don't go in there just to provide liquidity and get out in 3 months or 6 months or a year. If you're there to go into.
And I would argue that you want to have more than just direct lending or private credit, build a portfolio of opportunistic credit so that, particularly for family offices, going back to my tax point, you don't want to be in this just for ordinary income, particularly if it's highly levered underneath. Again, going back to ICG is in the market now with a fund 3. I'm invested in vintages 1 and 2. They've done incredibly well, which does have some private lending and some direct credit, but a lot of opportunistic credit. So it's a mix of capital gains and ordinary income, which is much better from a taxpayer's perspective. For pensions and endowments, direct lending is, it's a different issue.
A couple of unrelated questions, please. What makes this cycle probably different? Exposure to software and technology, right? So typically back then in the days, like we used some decent collateral, like physical assets or something, right? This cycle doesn't have any of that, right? Unfortunately, right? So please comment on that. And the second question, what do we say in terms of the in-kind percentages, trends, and developments, please?
I think in terms of picks, answering your second question first, you just want to understand when you invest in a fund or a pool of funds, what their ability to do that is. And again, that's underwriting the underwriting, right? How have the loans been underwritten? And is there the ability for the company to then start, paying in kind? So that's one issue. I think to your point about technology, I do think, and my personal opinion is there will be a washout from these technology companies because, as you're right, there's no real collateral, right? It's intellectual property at the end of the day. But, I think I told the story yesterday that in the original NASDAQ crisis in the 90s, I wish I had just bought a basket of everything and held it, because I interviewed for our podcast Kevin Ryan, who was the CEO of DoubleClick, for those of you who remember DoubleClick, which was really the first internet advertiser. And I was working at an investment bank, and we helped take them public. And I think I don't know if these numbers are right, but the deltas are close. We took them public at 400 million, stock got to 100, the valuation got to 150 million during the NASDAQ crisis, and everyone was like, oh my God, these things are all going to go out of business. They had no revenues. They should never have been $400 million in the first place. Well, lo and behold, fast forward, Google buys DoubleClick. And when the government was thinking about breaking up Google, they were valuing all these different pieces of it. What do you think that DoubleClick piece is worth today?
Couple billion.
Anybody have a get? How much?
Couple billion.
Try again.
10 bill. Plus.
10 billion?
I go 50 bill.
It's the whole architecture for Google's.
It's $100 billion.
$100
$100 billion.
Which is
And so
you mispriced it at 400 million.
well, it went down to 150 million. So, I don't know if we definitely
No.
mispriced it. I don't know which way, but my
It
point
depends
is,
on how much money you
my
have put in
point is,
since.
but my point is, if a bunch of these loans in the technology sector really get washed out, I would be buying them there and holding a basket and just, some amount of money that you don't have to think about. Some will be donuts and some will kill it. But again, it's credit. It's not, when I worked at Claren Road, I remember somebody came to us and said, you guys are so good at picking individual names on the credit side because we were long, short, liquid credit. You should start a long, short equity fund and do the same thing. And Brian Riano said, you got to understand the difference between credit people and equity people. Equity people are glass half full people because there's no cap to how well you can do. Credit people are glass half empty people because you can lose everything, but you can only really make par or a little bit more than par, depending.
Okay, so that's the end of question 1.
We got 10 of them.
I had
You told us to make it a discussion.
I had 10 questions. I don't think we're going to get to them all. So we're going to jump down to, let's drill down on a concrete stress case. Commercial real estate office sector has been repeatedly cited as a pressure point. How severe is the damage, and what does the workout or restructuring process actually look like for credit investors caught in that exposure?
I'm going to give that to Ron because I am not a real estate expert.
I'm not sure whether this question belongs to this group because this is a commercial real estate. And majority of times, the sector is really, when they say senior secured, it's not secured by real assets. It's secured by essentially EBITDA coverage, things of that nature. So it's based on forward-looking and past history. But as far as the real estate is concerned, I think the office sector is probably at the bottom of especially if you're looking at office and suburban office is really one that everybody's running away from. There are plenty of good sectors that are even emerging sectors in the industrial sector, in the manufacturing, in the that are the idea of single family rental has multifamily has multifamily itself. You have the issues of suburban versus primary markets. So just like credit, the private credit, real estate is not a homogeneous thing. Every block is a different story. So my view is that real estate as an asset class is not going to go away, and office is not going to go away. There is a lot of innovation coming to the table to take the same space, use it in multiple different ways, but blending of technology and a space, and be able to bring it with the circular economy. I think the real estate sector is learning that it's an operating asset class. It's not a just lease it and forget it sector.
Yeah, I think I would just add again, real estate tends to be a place where people get very levered. So that's something that you really have to take into consideration. How many real estate developers go bankrupt, then they make money, then they go bankrupt, then they make money? It's generally because of the leverage levels. I would also say I would be very wary of investing in secondaries of loans in the real estate space. I think the origination of new loans here are really interesting, but it goes back to underwriting. I think you want to be location, top ends. I wouldn't want to be in sort of secondary tier, peripheral, areas at this point in
So I
time.
think
Personally,
you can take a look at bridge loans as really primary, and that requires fully understanding what that bridge is about. You're bridging to nowhere or bridging to a reviving an asset. And that's really opportunistic. You're dealing with very smart people that are bringing new concepts to a already distressed situation. So there is definitely potential, double digit, even high double digit return potential. But again, I would leave that to the professionals and not try to do that yourself.
yeah, I mean, exactly. And I was just going to say, unless you have terrific expertise in the area, you want to invest with somebody who has the expertise and has a really diversified portfolio, because it's going to be very bifurcated, in my opinion.
So I want to go back to question one. What is the extent of warehouse lines playing in all of this? I mean, I assume that some of these creditors have substantial warehouse lines from banks, maybe.
You're saying the funds being themselves leveraged?
Yeah, that's what I'm saying.
Again, you need to look at it. Some are, some aren't.
Yeah, I mean, I think also
I'm saying, do you have a feel for it, or
Most of the time, no. I think these are supposed to be double-digit return. These are not your typical bank loans. The bank loans are, essentially going to CLOs. These are supposed to be, to below investment grade, in some cases, single B or, non-rated, but you're getting quite a bit of covenants. If they are covenant heavy, but most of the time that's what happens.
you're saying there's a whole architecture of CLOs on top of it as well?
No. I was saying you need to differentiate the leverage loan deals that go into the CLO market versus
versus warehouse.
Well, I think it goes back to what I said earlier with, you need to know what the terms of those warehouses are, right? Can they be pulled, because the bank decides to pull them, or do they have a 3-year life or a 5-year life? I mean, I think that is the big question, right?
I'm just trying to understand the potential ripple, if there is one.
Do you know a company called Highland in Texas?
Yeah, sure.
So where are they today? The Highland was actually private debt, smart.
They were like a huge fund back in the day. Sure.
But during the credit crisis, they got totally wiped out.
And I think there was litigation between the
All
parties.
litigation, all sorts of things. And what happened was, actually, we were, as a company like us, we get into auctioning these assets. So when the street does not auction these anymore themselves, because they need to bring an independent.
Yeah, but there was a big hedge fund on 45th Street and
a lot of
Fifth Avenue, whatever, Madison, back in 2008, that had all these, asset-backed loans, and then they levered them too. I mean,
is that
well, again, it depends on whether the leverage can be pulled.
If you look at Churchill,
it wasn't Churchill. No.
I was in Churchill. So there are a lot of these things post-credit crisis. Even though there's distress, they end up getting additional money, and they actually survived as BDCs and other forms. They went into permanent capital because they had the expertise. The biggest asset of these entities are smart lenders. I mean, the guys who are doing this, they know what and the problem was I think what has happened is that the buyers became very unsophisticated, and the buyers ended up they get into, as the valuations were increasing, they got in at the wrong time. But the sector itself, I think, is going to effectively normalize and actually create more capital will come in afterwards.
But again, I also think you really have to understand the nature, right? Because banks and people who give warehouse lines and things like that, they pull them at the absolute worst time. I mean, look at the quant quake of 2007, when a lot of the quant funds, which were very levered, had problems. That was because the banks pulled their leverage and forced them to sell at the very worst time, and things rebounded very, very quickly. But the funds didn't rebound because they had to unwind, because the bank said, we're taking your leverage away. Long-term capital blew up for the same reason. The leverage got taken away at the exact wrong time. That's what you really have to be concerned about. And that's why, again, underrate the underwriting and understand how the leverage is structured.
Okay, so Marty, anybody in the chat want to go back to question
let me
one?
ask.
Because I want to get past question one.
Not yet. I haven't asked Goodwin yet. So I'm sure Goodwin will have some input. So
Okay.
in terms of the public markets, you see banks and financials in general trading like crap, unfortunately.
Sorry, say that again.
In terms of the public market, equities of the financials, including banks, are trading like crap, basically. And triple C spreads are months over months about 90 basis points wider. How would you interpret that based on what you see from the private markets? Are these acting as a leading or overly concerning or lagging indicators?
It is absolutely essential for the banks, for this sector to survive. In 2008, I was being chased by a CIO office of a major bank that is not to be named to start lending to the sector because the existence of CLOs was a way for them to grow the business. So this sector is essential to Wall Street. Therefore, the banks will support the sector at the right time.
But I think going on to your question, I think you're talking about like Apollo and Blackstone and Ares and all of these names have traded down. Blue Owl, obviously, the public names in this space. Do I think it's a leading indicator? I think it's an indicator that there are definitely problems in the sector. I think it's also created some real value because we all know, particularly in retail markets, like there's that old story, right? If you'd invested in the S&P 500 in 1929 and done nothing, you would have done better than anything. But human nature is to do something. I mean, I think I again said yesterday when the NASDAQ crisis in the 90s, I was young in the business and I had a little bit of money and I was long only in the market because I didn't have the ability to access alternatives at that period of time. And I panicked and I was like, I'm just going to sell everything. And my father said, you make more money sitting on your tuchus than you do trying to be cute. So if you do nothing when things are bad, that's good. But what makes a market top? Everybody getting in at the wrong time. What makes a market bottom? Everybody getting out at the wrong time. So I do think that there's been, I mean, Apollo, to use an example, has gone from the mid 130s to 105 or 106 as of yesterday in the last 6 weeks, 8 weeks, because there has been this concern and this ripple effect from all the bad news about Blue Owl, et cetera. Apollo's not going out of business, right? They've got a very good business. They've got a strong business. They've got a great team. And I think it's probably some of those names are a buy here, but you have to be selective in which ones. I mean, I'm not going to say publicly which ones I think are the ones I would buy and wouldn't buy, but you know, there are going to be winners and losers, but none of these massive firms are going away. And I think that there's actually some good value to be had. And I'm actually adding to some of it. I mean, I don't generally personally buy individual names, but I do for my daughter's trust. And we are adding in some of those names to her trust.
How about regional banks?
The regional banks are really looking at the syndicated bank syndicated loans. They're not in the, I think they're not in the private debt, and they're not exposed. Banks are supposed to underwrite, right? At the end of the day, they buy loan participation. Loan participation is only offered by the banks, so that you have a syndicated loan business. So if you look at syndicated loan, and there's definitely different categories of those, and they participate in some because they have to put their money. When you say regional, are you talking about 100 billion bank, or you're looking at a whole mess of things? If you're looking at a public play on this in terms of there are a lot of other factors that are going on right now in the marketplace that you need to consider other than just private debt market.
I think regional banks have become, because they've had to, because of regulation, a lot more conservative over the last couple of years. So they're certainly not in the position that they were a few years ago. I think you're also going to see continued consolidation in that area. I remember seeing Bruce Richards of Marathon speak about a year ago, and I don't remember the numbers off the top of my head, but we have more banks in this country per capita than like any place in the world by a multiple of, by a ridiculous multiple. Again, I don't remember what the numbers were, but Bruce has written a lot on this. And so I think there's going to need to be a lot of consolidation for these banks to survive. And I think that what people have to be really cognizant of is I don't think if there's a crisis again, the government's going to come in and rescue the way it did before. I think certainly in this administration, I think there would be allowed to be a fallout to clean it out and get to a place where we can start from a stronger base. But I think that you're going to see continued consolidation. And I don't think there's going to be as many regional banks in 5 years as there are today.
Question one, going once,
What did you go
going twice.
Okay, Chip, take control.
All right, we're going to move on.
Please.
But you two have done a very good job thus far.
We probably addressed most of the other questions.
Right, I was gonna say,
directly.
There's not much left to talk about.
On a positive side, infrastructure debt and asset-backed private credit have been highlighted as areas of relative resilience. What is driving that outperformance? And is there still meaningful opportunity for investors entering those strategies today, or have spreads already compressed the return profile?
This is my primary focus right now, infrastructure, both in emerging as well as developed markets. There is a huge amount of new technology that is available in the renewable, and they make sense. They're not driven by regulatory stuff. It's really trying to optimize the biomass and a lot of other assets that were just wasted. And also there is definitely global market for carbon credit. I don't care what our administration says. If you're Etihad, if you're Qatar Airways, if you're Singapore Airline, if you're American Airline, you're Delta, you're trying to buy biofuel right now because the regulation is there, and they need to offset. And it's not really governed by us, it's governed by Europe and everywhere else. And it just makes sense. And these areas lead to building new facilities. And also when you look at electrification in America, you have massive amount of battery technology that's being combined with the restrictions that we're putting in on foreign dependence in these areas. I would definitely look at infrastructure that goes into the building batteries and also graphene and a lot of complex materials that the mineral section yesterday was really covered. So you're going to see essentially a huge amount of build out of at home technology that requires capital, and that capital should be project finance, not equity. There would be the equity in the technology side, but I'm very, very, very bullish on combination of tech and renewable.
I would just add to that. I mean, as much as I think there's going to be ultimately a shakeout in AI and there are going to be winners and losers, there's a lot of physical plant that needs to be built behind AI to support it. And I think that those are areas that can be very interesting to lend to: data centers, storage facilities, and things of the like. And again, I'd rather be lending to something with a hard asset behind it than an idea.
So when Chip asked if the audience had anything to say, now they've all joined in here. So JP Morgan this morning marked down some of the loans made to software companies. Is this the beginning of more markdowns? Should we wait a couple months before jumping back in?
I would wait.
No, software as a technology, software as a service is severely under pressure because the alternative is using agentic AI, right? So a lot of these companies that have been providing tech services and they have been charging the banks massive amounts. I mean, I offered those services to to some of the banks. Those services is pretty much going to be driven by very much a whole different set of software that does not involve people. And these companies are charging by the hours or by subscription. And so I think you're going to see a massive repositioning of these tools. And we don't know yet who is going to be the winner, who's going to be the loser, right? And that's where I would be very careful about the software technology, because a lot of people have 2,000, 3,000, 5,000, 10,000, people sitting in India or elsewhere. They're going to find themselves.
Marty.
I fired almost all my India stuff.
Oh, okay. But I
have about 20 people working in India, and every day I find a reason to fire them.
I just want to add.
AI just takes their place.
I just wanted to add to that though. I do not think this is a falling knife trade. I think you're going to have time to get back in. I think there will be a moment where you'll see some value in that area. Again, winners and losers, but I don't think you have to rush. I think you're going to have time to let it play out, watch, and then make decisions.
So that was one of the other comments by another audience member, which is that They think it's going to be considerable consolidation and markdowns, but they think that there will be some will be marking up as well in a few months.
Yeah. But I think you're going to have time to get some visibility on it. I would not be. JP Morgan marked it down today. Maybe there's some market concern or nervousness. I don't think you have to rush. I think you're going to have time to let it play out and get visibility to make decisions.
Somebody mentioned that there's been a lot of Bloomberg killers out there that never came to fruition.
No, I mean,
In terms of
look,
agentic AI
no.
reviews.
So I think what you need to that's data. That's not technology. So Bloomberg's value is data.
Yep.
And data, I would say, data is the key to everything. For example, when you go into AI, it's not the algorithm may be smart if you're not feeding it the data. For example, data in in plant genomics. You need farms. You need to collect a huge amount in order to create the best, essentially species of plants, and then you kill everybody else who is not using the best technology in producing the plant. So in that situation, I'll call it physical AI. Even though AI is being used, the data is the one who really is the providing that new species of plant. The same way you drink the best wine, you know where the roots of that came from, Burgundy or Bordeaux. This is not unknown that the plants have different genomics.
I'm going to argue that Bloomberg has an unsurpassed network.
I was just going to say, you have to remember that Bloomberg has unbelievable resources to throw at these things. And if you think that they're not ahead of the curve in whatever is going on in AI and agentic AI, they're working on it, and they're there, and they've got the people to do it. I mean, Michael Bloomberg's favorite saying is, "In God we trust, for everything else bring data." And I think Bloomberg has been a continual innovator. Again, the company is so profitable. They have the ability to spend money on doing all this stuff. And Michael is a very forward-thinking person and is still very much at the forefront of that company. So I'm not worried about anybody killing Bloomberg.
So there's another comment, which is that software and services will be based on outcomes going forward and not on the longevity of the service. So you're talking about they bill hourly or they bill contractually, whatever. But
I think going back to data, there's definitely agentic AI that can collect data that Bloomberg has essentially allocated and applied. So data aggregation
Bloomberg already owns a lot of the data.
No, these are public available. No, they're publicly available data provided. Any public company, the data is really public. It's just that nobody has put them in one place. The key is how much you have to spend money to make that data searchable and usable, and that has changed. So when you have to hire armies of computer programmers, now I can create 1,000 programmers agentically. So I can essentially, my cost of going back.
Yeah, but you still need humans to look over that. I mean, we're not at the point yet where you can trust these things. I mean, Marty helps when we do these podcasts. We often generate the first pass of the questions using AI, and sometimes they're spot on, sometimes they're somewhere in between, and sometimes they're completely wrong. And as my daughter's 8th grade teacher reminded us at parent teacher night, tell your daughters AI does not know how to do math. It will get the answer wrong. So tell them, if they think that they can get away with using AI to do their math homework, it ain't going to work. So it's not the be all and the end all today.
I'm not discounting that the Bloombergs of the world are not going to survive because they have a very deep pocket, right? They're going to change.
I would argue there aren't Bloombergs of the world. There is a Bloomberg, and it's pretty much ahead of anybody else in the space. But
you have Russell.
Yeah,
you
but
have
let's get away from it.
Reuters.
The real issue is what's going to happen to software, and because I think that's a concern here.
The answer is data. You got to look at data and
winners and losers. Winners and losers.
All right, guys. All right. I'm not going to be the reason that we're behind.
No, we got about 10 more minutes.
I know. That's why I'm going to ask one more question. The rapid growth of private credit over the last decade, from niche asset class to multi-trillion-dollar market, has brought in much broader set of participants, including insurance companies, retail vehicles, and non-bank lenders. Has that strengthened or weakened the market's ability to absorb stress?
I think we've addressed this a little bit already, but I think it's weakened the market's ability to absorb stress because I think some of those players don't understand the underlying liquidity here and are going to want their money back and panic at the wrong times. So I would say weakened because the market had gotten so big. There's a lot of loans that have been made going back to saying people had to deploy the capital. There's been a lot of loans made that haven't been underwritten, certainly the way I would want them underwritten.
I would say agree with that, but the players that are in there, sometimes they're stronger than even, I think private equity has moved over to private debt. So if you believe that private equity should not have existed and the growth of private equity should not have been there, or venture capital, so it's just a cycle. I think it's one that the sector itself has to go through a few iterations to get rid of what are considered the tourists. Once you get away from the tourists, this is a sector that is absolutely created by the banks and the private equity firms to be able to provide capital in a very efficient way to the sector.
The sector's not going away, but again, it goes back to underwrite the underwriting. And you have to ask yourself, certainly for the larger private equity firms who've been able to hire big teams who have expertise in this, but the same guy who has the expertise of knowing what company to LBO or what company to buy on the private equity side may not have the same expertise in terms of underwriting it. It goes back to the equity people are glass half full people, credit people are glass half empty people, and it's a very different mindset. So for the larger firms that have been able to bring in new teams that have these expertise, that's one thing. For smaller firms who've got the same team that was doing the private equity now doing private lending, I'd be a lot more skeptical.
There are people who got into the sector. They were big firms, but they were more into liquid equity debt. They thought they can have I'm not going to mention names, but there are some that have gotten black eyes because
it's a completely different business. I mean, we invest in public equity. I mean, public equities and public debt. We have done some lending, bridge loans, mostly for companies where we're already involved in the cap stack, but that's not our business. At the end of the day, we think having a vehicle to take distressed private lending, because we know how to do restructurings, will be a very interesting business, but they're two very different skill sets. But Chip wants to go to the next question.
I do. I really do.
Go ahead. Let's go.
5 minutes.
But I was going to do, should we talk about regulators or looking forward? I'm going to go looking forward. Regulators are the bane of my existence. Looking out 12 to 24 months, where do you see the best risk-adjusted opportunities in private credit? And conversely, where would you tell a sophisticated investor to stay away? Give us your honest conviction view on where the puck is going. You guys know hockey, right? Okay, good.
Wayne Gretzky, isn't that his phrase?
Yeah.
Yeah. I would say that you want to have a diverse portfolio across opportunistic credit, not just direct lending. And I think if you can invest in new clean pools of capital, like if there's somebody that's now raising fund 3 and the capital hasn't been deployed yet, that's cleaner than maybe investing in BDCs at this point. But again, depending on your liquidity profile, I think really understanding who you're investing alongside of. You don't want to be in a situation where the vehicle is more liquid than the underlying assets, and then the people who don't really understand what's going on all run at the wrong time, and then the good stuff has to be sold, and you're left holding the bad stuff. I mean, as Ron has said, this sector's not going away, right? It needs to exist for the financial markets to continue to operate efficiently and for the market to continue to grow. So it's not going away, but underwrite the underwriting, really understand who the managers are. I tend to prefer smaller, nichier managers that can look at off the run stuff, because the problem is the larger deals, they're all food fights, right? Apollo's competing against Carlyle, competing against Blackstone, and they're paying too much, right? Because they can't do $100 million deal because it doesn't move the needle. They need to do $1 billion deal. And there's 5 or 10 of them that can do those billion-dollar deals, but they all need those deals. So those deals are not going to be priced as well as I think the smaller, nichier areas. But I would not be focused solely on direct lending, private credit. I would look at opportunistic credit as well.
I think it's very important when you're investing, you need to have a policy, you need to have an approach and a strategy. The sector deserves a portion of your portfolio to be in it. So figure out, sit down, and figure out how you want to play it. I'm not a fan of in and out kind of a thing because this is not a sector of in and out. You may be timing it properly, but you only get 10 years, every 10 years to do that. But you're going to be giving up, the spread of the public versus private. You're looking at close to, 5 or 6% additional yield per year. It's not something to ignore, and that. We actually had a private debt offering that was backed by commodities and backed by zero default. But when the spreads in the public widened so much, we couldn't place that because our spreads were very stable. We couldn't change them. The borrowers were not willing to pay, 20% on bringing sugar from Brazil to America, for example. So that those sectors are not going to participate in this manner, and therefore you're going to find situations where certain sectors get deprived of capital because the public markets end up being in distress situation. But I think if you're going to go there, pick asset-based, collateral-based, short, natural. For example, I like the lender-to-lender projects where people, you're lending a commodities that go from, Brazil to here. If you can find the right guys, I'm advocating myself in this case, so I'll disclaim that. So we've worked on a situation where short and juicy. So we have natural liquidity every time we arrive at a port, we have the liquidity. We get it back and recycle it back. That's a different way to get to 10 to 12 or 13%.
Ron?
Howard has a question.
Yeah, we got Howard and then we got Jody. So and we're out of time. So Howard, quick.
Sure. So first of all, the two of you are great. Do you think that with so many retail investors getting into this, and the numbers have just come out from Blue Owl and HPS about the percentage of requests that for liquidation have come out. They had a 5% cap, and HPS just announced that 9% has been requested. Blue Owl even more than that for the last quarter. Do you think that the regulators are going to start putting a kibosh on a lot of the opportunities that are out that the retail investor who got into it and really didn't understand what they were getting into, no matter how much they were told that it's not liquid, that this is going to affect the overall market?
Listen, I was skeptical of the retail getting in this space in the first place for this very reason. In terms of you never know what regulators going to do, right? My instinct is, while we're under the Trump administration, they're going to let it ride. He wants this to happen, and he's not one to be rolled over. So I don't see anytime soon. Not that I don't think it should be.
I think you read their offering memorandums. They have some of the smartest law firms written. There is no way the regulator can come in and say they did something, fraudulent. So there is no regulators has to have a base to come into something, right? So these products have gotten into the retail's hand as the people who are investing. They are not your mom and pop. They're declaring and they're writing that they're qualified.
That's not the case, actually.
It's not.
No, 401k. I mean, they've allowed more retail into these.
You can actually get into some of these.
You have an advisor doing that. The advisor is taking the.
No, you can get into them right now with a minimum of $2,500 that you can get into these private credit funds.
But they're not accredited investors? So it's like a B-REIT type of permanent vehicles type?
Say that again?
And B-REIT, that was Blackstone REIT that was offered to a smaller retail.
So BlackRock purchased HPS.
Mm.
So HPS is under the auspices of BlackRock now, and I believe the minimum is $25,000. And the only regulation is that it can't be more than 30% of your overall investments.
No, I
So-
think
Listen,
that's-
I've said from the beginning, this is a problem. That to your point, that the more, even this has been explained that these things are not liquid, people don't listen because they're used to being able to transact effectively daily, whether it's in a mutual fund or a stock. And so that was the big mistake. And people are gonna be stuck with what they've got. I mean, that's just,
And that's the reason that I asked, maybe not for people who are already in, but for future investors.
There was another comment from the audience.
I just don't think that the Trump administration is going to stop it for the
I don't know
moment.
if you have to leave, but with JPMC restricted lending to some private credit funds this morning, will that precipitate more restrictions or other sources of liquidity step in?
I missed the first part. Sorry.
JPMC is restricted lending to some private credit funds. So are other forms of liquidity going to step in, or is this just going to?
This
I
is
think
the
it's gonna
funds
cause a
not having
problem.
liquidity themselves.
It's going to cause more problems because I don't think JP Morgan isn't going to be the first one, right? Goldman will follow that. They'll all follow because they're worried, right? Nobody wants a financial crisis. Nobody wants risk. And that's what goes back to what I was saying. Like, you really need to understand what these warehouse lines or credit lines or things look like. And, all it's going to do is dampen returns, right? Because the direct lender may still have money in their fund to make loans. They just can't lever them to get the same returns.
Jody, do you have
Jody, you had a question?
done? Good, okay.